This is InvestTalk, our daily podcast about making the most of your invested dollars, taking the money that you've worked for and putting it to work for you. The anchor of this hour is not a financial commentator or self-proclaimed expert. He's someone who makes his living managing money every day. He's registered investment advisor Steve Peasley.
Good afternoon, everybody, and welcome to your daily edition of Invest Talk. We're glad you've decided to spend a little time with me, this 1 hour at least, in this afternoon. Our mission during this hour is always the same, to try to help you be a better guardian of your investments and try to enjoy a comfortable retirement. We keep a close eye on risk, on your stocks, what the opportunities might be, and where the dangers are. And of course, I have been saying for some time and continue to say, the biggest danger we have is our subprime. But we want to hear what your questions and comments are, not mine. I love talking. I'll talk for the whole hour, but I want to hear what you might be thinking about this market. So the number is 888-99-CHART. You can call right now, 888-992-4278. How about Chris in San Diego? How you doing, Chris?
Hi, Steve. How are you?
I'm great, and I appreciate you calling.
The other day I heard you talk to another gentleman with regards to TSP monies and rolling it out when you're eligible to roll out. And I'll be having to roll mine out in about 3.5 years. Mm-hmm. Would I roll that into an IRA?
Yes, you would.
Would it be a taxable IRA or a Roth IRA?
Nope, it would be a non-taxable IRA. It won't be a Roth. It'd be a regular IRA. It depends on the money we're talking about. I'm assuming the TSP money we're talking about is retirement money that has not been taxed.
Correct.
Therefore, you will roll into a regular IRA.
I see.
But when you get closer, Chris, you want to talk to accountant, talk to me again, because rules change.
Okay.
Because you're talking 3 years from now, that's still a ways to go.
Yeah, and I'm putting in about 10% into
Good for
that.
you.
So, yeah,
now, see, Chris, I want everybody to do that. That is more than most people would ever consider.
Well, listening to you guys, how could a person not?
Well, I appreciate that, Chris. If I can get just one person to do that, I'm happy. I can't get my own family to do that, so they won't do it. Chris, how old are you?
You guys make a lot of common sense. Thank you.
Thank you very much. 888-99-CHART is our number, 888-992-4278. Our talking point today is 5 sell signals. What are some of the sell signals that are out there? When do you know when to get out? That's always the most difficult part. A lot of people get out right at the bottom when everything's already fallen, and then they get out. That's not how you do it. You want to get out on the rise. If you think you're going into a recession next year, if you think that's true, the market's not going to go straight down in one day. It's going to give you spits and starts, a little rally here and there, and you would sell on those, sell back on those. Don't sell at the very bottom of things. It's a hard thing to learn, very difficult, and then you have to decide what you're going to sell. Do you sell your losers? Do you sell your winners? Do you sell cyclical stocks? Do you sell growth stocks, value stocks? What do you sell? Do you hold on to defensive stocks? Always, always, always a difficult choice. There's nothing more challenging than how to make a decision to sell. Not too early, not too late. It's difficult. That's the talking point. There's 5 sells. This is an article by Forbes, by the way, Forbes.com. And it's going to be the talking point. You can call right now and be part of the program. Let's hear about what your talking point is. 888-99-CHART, 888-992-4278, and you get through right now. Every question is an opportunity to learn something new, everybody. And who knows, the next thing you learn could make you $1 million. We don't know. We'd like to hear your question. Now is the time to weigh in on the Invest Talk listener line, 888-99-CHART. Lorem, Oakland. How you doing, Lorem?
Pretty good. Thank you for taking my call. My situation, basically, I had a 401k with a previous employer, and then when I left that employer, I switched jobs. I went to another employer, basically hung out with them for a year, and then I'm at a new employer. Mm-hmm. So my previous 401k is I've not been able to contribute much into it. My current employer right now doesn't really have a very good 401k. They don't have any pre-tax matching. And I was looking into opening another IRA, And basically, I came across some of these funds, which are called time-managed funds. I was looking at T. Rowe Price, Vanguard, and Fidelity. I wanted to get your take on it because I'm 40 right now, so I'm looking at like a 25-year, the 25-year product that they have.
I'm familiar with those, and I particularly don't care for them. It's not like they're bad. I don't want to say that. I just don't care for them because of the automatic way in which they move from stocks when you're real young and slowly go to bonds when you approach retirement. They can move toward bonds at the very wrong time in the market. They don't pay attention to what's happening in the real world. That's not what they're paying attention to. They're basing it on your age. So interest rates could be really high or really low, and they're still going to move to bonds. And bonds notoriously are bad performers. Yes, they will get more conservative as you get older, and that's really what they've been designed to do, to get more conservative. And how they do that is they generally buy bonds.
I see.
And it's for everybody else, what they do is they'll say, okay, we have this, I forgot what they call them, but they'll have a date on it, like 2025.
Exactly.
And that's the date you're, quote unquote, are going to retire. And as the time gets closer to that date, they change the mix inside to get more conservative generally, and that means buy more bonds. Well, what if in 20 years from now, 5 years before you're retiring, interest rates are 4%? Who wants to be in bonds?
Right.
Yeah, you know what I mean?
Well, Steve, here's a question I have for you. What would you recommend for me where, I'm 40 right now, and I'm trying to get my wife and I are going to open individual IRA accounts, and I'm the type where I just want to go super aggressive and just go put the pedal to the metal.
What I want you to do, Lorem, is I want you to go to investtalk.com, email me, remind me of this conversation, tell me you're going to do IRAs, right?
Right.
Tell me the amount of assets you're going to have in the IRA, and I will give you a list of mutual funds that you can invest in. They'll be I think will be over 25 years, far outperform those time management type of accounts.
That's great, because I don't qualify for the Roth, so that's what I'm just trying to seek out right now.
Yeah, just email me. I'll be happy to do it. Thanks, Lauren. Appreciate it.
Appreciate it.
Let's go to Al in Seal Beach. How you doing, Al?
I'm doing well, Steve, and yourself?
I'm doing pretty good. Considering, exactly. How's that? Considering.
We'll leave it at that. I did call you about this. I got Kraft as a spinoff from Altria.
Yes.
And I want to sell it. Do I need to wait for a year? Because I think it spun off in like March. I believe. I'm not positive. That's when I got my shares. But do I have to wait a year for it not to be for the capital?
So your question is there capital gains? I would say the answer would be no, but I don't know this for sure, Al. When did you buy Altria?
Oh, I've had it for 10 years probably.
See, that you could argue, and I think, I would ask an accountant out there to give me a call because I've never had this question asked before, never looked it up. Mm-hmm. But I would think that your cost basis of Kraft was the day you bought it was way back when Philip Morris, when you bought Philip Morris, when it was part of Philip Morris,
right?
Not when the spinoff happened.
Understood. Yeah, because I own Philip Morris. Now that I look, like I'm going on 15 years.
Yeah, so that means you'll have long-term capital gains when you sell it. He's asking about long-term capital gains versus short-term capital gains. That's what he's really asking about. Long-term is 12 months or longer. Short-terms are 12 months and shorter. Short-term means you have to pay an ordinary income tax level rate. So if your ordinary income tax rate is 35-40%, then that's the tax capital gains you have to pay. If it's long-term, you only have to pay 15% no matter what. I'm pretty sure, Al, this is a 15%er because you've had Altria for all that time.
I appreciate very much your time, sir.
Thanks, Al.
Again.
Appreciate the call. Hang in there.
Thank you.
Thank you. Let's go to Sid in Fremont. How you doing, Sid?
Hi, how are you doing?
I'm hanging in there.
Very good. Ben Graham.
Yes.
Okay.
The grandfather of value investing book is the Intelligent Investor.
Okay. Mm-hmm. Which is why I'm talking to you. No.
Right.
They have a formula for intrinsic value.
Mm-hmm. Ben Graham does, yes.
Right. How do you feel about that, first off?
Well, got to remember, he wrote this book in the